Good afternoon and welcome to the November BetaShares webinar, Rational or Irrational Exuberance. This is the latest quarterly economic and financial update webinar. So thank you very much for joining us. As it's 12:30, we'll begin right away. I would just like to remind everyone before we begin that the information and views shared today are general in nature and don't take into account anyone's personal circumstances, should not be construed as financial advice, and before taking any action you should speak to your financial advisor or professional before making any decisions. So a little bit of housekeeping before we start. A recording of the webinar is taking place, and we will send the webinar recording to all attendees. And also on the right hand side you'll see a tab where you can ask questions, and we absolutely invite you to do that throughout the session, and our host David Bassanese will take those questions at the end, time permitting. My name's Sarah Hare and I'm the Marketing Manager at BetaShares, and I'd like to introduce David Bassanese. Many of you already know him. He's our BetaShares Chief Economist, formerly with the AFR, Macquarie Bank, regularly quoted in the AFR, The Age. He can be seen on Sky regularly, and very much a renowned author of the Australian ETF Guide. So an absolute expert. A nice introduction.
Right.
So Dave, do you want to take it away?
Sure.
Welcome.
Thank you very much, Sarah. Thank you for that very kind introduction, and welcome everybody to our latest quarterly webinar. Look, and again, pretty good news, I think. I'm pretty upbeat at the moment about things, particularly globally. But let's run through it, and starting with the overall. So basically, we'll start with the international market outlook, then what's happening in Australia, and then following all of that, some specific investment ideas, both locally and globally, based on the backdrop. So first chart for you all is the global backdrop. There we go. So yeah, first chart there's the global PMI. That's, I guess, the best single summary measure of sentiment and activity globally, is that green line there, the global composite index from market. As you can see, it's running. It's the latest number is at 54. The long run average is 54. So that index is basically suggesting global growth overall is running at around a reasonably good pace, around about its long run average level. And as you can see, you know, basically conditions overall you could summarise as pretty good, not as good as we were prior to the GFC. I mean, so global growth, you know, prior to the GFC between say 03 and 06, 07 was running at a stronger pace than it is today, but still nonetheless pretty good. And you know, given that we've had population ageing over the last few years, you know, a somewhat slower pace of growth is not that bad. And in fact, it's still been consistent with unemployment rates around the world, many regions falling. So just looking there, if you look at developed versus emerging markets, also pleasing is that you know, the developed world, by that I mean the United States, Europe, and Japan, parts of Asia are showing particular strength even relative to emerging markets. And again, if you then go to the next slide. Looking at the breakdown between, you know, those areas, Europe, US, Japan, what you're seeing is that up until recently, the growth was strongest in particularly the United States and to some extent the UK relative to the Japan and Europe. But again, most pleasing is that over the past year, things have picked up relatively well in Japan and the Eurozone as well. So again, we had some GDP numbers out for both the Europe and Japan this past week, and showing things humming along pretty nicely. just a little at a side, I mean, people, if you look at Europe, I mean, one of the interesting things just in Europe is that the refugee intake over the last few years, something like 2.5 million refugees, 1 million of which flowed into Germany, which, when you think about it, is actually helping underpin their growth at the moment. So it's helping underpin German growth, something like 1%. Addition to German population growth over the last few years coming through. That's not the only reason, but it's something that I just think bears noting. Doesn't get a lot of coverage. People are focusing on the European Central Bank and low interest rates, but you know they have had this, I guess, in a sense, a positive supply and demand shock as well from that refugee intake. Next slide. Again, the good news continues in the sense that inflation globally remains quite low. So there is a core measure averaged across the headline one can jump around given what's happening with oil prices, commodity prices in general, but the underlying one you can see it's still been pretty low and flat. Overnight we got the latest US CPI result that showed in the year to October core inflation was still only 1.8%, still a little bit below what the Fed would like. Again, not bad, but still a little bit less than what the Federal Reserve would like. Looking at the next slide, and again, this is probably the single most important slide in terms of how the globe, whether or not we remain bullish or bearish over the next few years, is what's happening with US wage inflation. So if you look at the blue line there, that's average hourly earnings growth in the US, and the red line is the unemployment rate. So unemployment in the US has dropped down now to around 4%. Wages growth has picked up from where it was a few years ago, but over the past year or so, it's more or less stabilised at just over 2.5%. Had a bit of a spike up in the last few months without going into it. Basically, the hurricanes in the US caused a lot of job losses in the hospitality sector in the southern states. Given they have below average earnings, it caused a spike up in average hourly earnings, but as they've gone back into employment, that average measure of earnings has fallen back down again. So in the latest number there, 2.5% annual growth in US average hourly earnings, still pretty benign and consistent with, as we'll talk about, central banks and particularly the Federal Reserve not needing to withdraw policy stimulus very quickly, which is very, good news. So what does all that mean? Equity markets have continued to rally. So just a chart of a bunch of different indicators there, and you can see that certainly in the last few months had a particularly nice turn up in the European and the Japanese markets. Just to put some numbers on that, we have a couple of European ETFs. I'll talk a couple of the ETFs covering those markets, which I'll mention later. But our European ETF is up 7% in the 3 months to October, and 26% in the 12 months to end October. And our Japanese ETF, HJPN, is up 11% in the 3 months to end October, and in fact up a whopping 32% over the past 12 months. The other one, which again I'll be mentioning a bit later, is the NASDAQ index, the US NASDAQ tech-focused index, and that's up around about 11% over the past 3 months. And again, and around about 30% over the past year. So, some pretty strong results there in many markets. Going forward, all that global growth has been positive for earnings. This is a slide of earnings expectations for the global MSCI index. So it's like the benchmark equity index covering all the major markets of the world. And basically what happens is, it's basically the rolling monthly forecast by analysts as to what they expect earnings to be in each calendar year. As you can see, generally analysts expect earnings to be higher in the year ahead than they've been. And if earnings expectations don't get revised down, it means that the forward earnings measure rises over time. So that's like a weighted average of current and expected future earnings. So as you can see over the past year, earnings expectations for both 2018 and 2019 haven't been revised down. In fact, there's been gradual upward revisions, particularly for 2019. And so that's meant that the market's measure of forward earnings, and again, when we talk about valuations in the market, price to forward earnings, it's the equity price relative to that dashed line there of forward earnings. Forward earnings have been rising. Now, and also, again, if you look at 2019, if earnings expectations aren't revised down, even if they just sort of stay steady, that dashed line there by this time next year will move up toward that brown line, and it would be consistent with something like 12% growth in forward earnings by the end of 2018. So if earnings expectations hold up, you're still looking at pretty decent double-digit growth globally, which is going to help underpin equity markets. The other question is what happens with interest rates and valuations, but we'll talk about that in a minute. But the point is, at the moment, good growth, low inflation, earnings are rising, and likely to continue rising over the coming year. So far so good. So here's the more challenging aspects. We've got obviously central banks seeing the good growth. Still, the crisis has passed. The GFC is well past. Inflation is not as high as they would like, but things are good enough that central banks are slowly withdrawing the punch bowl, so to speak. And basically what you see there is projections of central bank assets as a share in billions of dollars over the next year or so. And we're looking at basically the Federal Reserve, the red area, withdrawing, basically running down its balance sheet. So it's selling back bonds into the market, or as bonds mature, they're not being replaced. And also the European Central Bank recently announced that it is still buying bonds, but starting in January next year, it will be buying less. So it will be reducing its bond purchases from around 60 billion euros a month to 30 billion euros a month. And sorry, just in sort of the US, they will basically allow something like $10 billion of bonds that mature each month not to be renewed. So their total balance sheet will decline by about 10 billion a month. Put some numbers on that, but at the moment the US balance sheet, Federal Reserve balance sheet, is $4.5 trillion, and based on their plans at the moment, that would shrink down to 3 trillion by this time in 3 years' time. So 4.5 to 3 over 3 years. 3 trillion is still well above where it was prior to the GFC. It was only around 1.5 trillion, but nonetheless will be shrinking. So that's going to put basically reduced bond purchases, putting gradual upward pressure on bond yields. The other challenge for the markets, or I don't know challenge, but the other issue we will face is, if you see the next slide, sorry, I did mention Bank of Japan, meanwhile, is still looking at buying as many bonds as it needs to keep Japanese 10-year government bond yields at 0%. So I've talked about a withdrawal of quantitative easing, but at this stage, it's still only a situation in the United States and in Europe, and certainly not in Japan. And in terms of other central banks, it's still only the European Central Bank, the Federal Reserve that is talking about raising rates. So the Fed has already raised rates a few times since late 2015. It's virtually guaranteed it will raise rates again next month. The market has got it more or less 100% probability, and nothing the Fed has said publicly of late would dissuade anyone from that view. So they will raise rates next month. And at the moment, the Fed's projections suggest it will raise rates 3 times next year on the back of continued solid growth and what it expects to be a lift in inflation. But as you can see, the market's projection, the market's only looking at 1, possibly 2 rate rises next year. So at the moment, there is a bit of a standoff between what the markets expect the Fed to do and what the Fed itself will do. And chances are, I think the Fed, will the Fed go 3 times? Maybe the Fed does go only twice, but maybe a bit more than what the markets are priced in, but less than what the Fed currently expects. And again, my core view is that US inflation is going to continue to basically not lift as much as the Fed would like. It's likely going to stay just under 2% or close to 2%, which means the Fed will have the decision to, will it basically raise rates, even though inflation is lower than it would like, or will it continue raising rates? Either way, we're looking at fairly modest tightening Again, so we're only talking about the US here, and even the markets are second guessing how much it will raise rates. And all that means is that bond yields will probably rise only gradually. Looking at global market developments overall, just in the next slide, again, a key feature to note that the surprise this year has been that the US dollar and US 10-year government bond yields have fallen, even though we've had Donald Trump in power, we've had talk of US tax cuts, we've had good global growth. But if you look carefully at the charts there, we have had a turnaround in both the US dollar and bond yields over the last couple of months. So I think that upward trend in both the US dollar and bond yields is basically reasserting itself. A couple of things there. There's more and more talk of tax cuts in the United States. So I think Congress is getting close to agreeing on a package. There's still a bit of negotiations to go there, but that's something I think markets will look forward to over the next few months. Also, we've had the ECB basically finally announcing that it will be cutting back its bond purchases next year, and the markets, in anticipation of that decision, have been pushing up the euro throughout this year. But now that decision is reached, it's almost buy the rumour, sell the fact, and I think you will see some euro weakness re-emerge, which will push up the dollar. Meanwhile, the other notable thing there has been happening globally. Oil prices have pushed up on the back of expectations that OPEC will extend its production cut agreement. Again, that's which will probably happen, and then that meeting will be on November 30. But I don't think oil prices are due for a sustained rally. I think they're still going to be constrained at rising not much beyond $55, $60, because at the end of the day, you've got US producers who will come into the market to fill any gap that OPEC leave behind. So I'm still not super bullish on oil prices, which makes me still pretty relaxed about the inflation outlook. Gold prices have come off a little bit of late, also on the back of the US dollar strength. And again, I'm not super bullish on gold prices, simply because I think the US dollar will start to strengthen again, and we're in a generally a risk-on environment at the moment with equity markets rising. So it's not sort of conducive to gold strength. Having said that, gold will be the asset class that will be where people go to if things go wrong. So, as a sort of tail risk investment, it sort of still makes good sense as a source of diversification in one's portfolio. What about markets? So I've talked about earnings in terms of global markets. What's the situation with valuations? And just looking at the next slide there. So basically, you've got four charts there. One is earnings and prices. You've got 10-year government bond yields. You've got the market's price to earnings ratio, and then you've got what's called the earnings to bond yield gap. So it's basically the PE ratio inverted, gives you the earnings yield, and then you take away the bond yield and you get that earnings to bond yield gap. And that's, I guess, that bottom slide there is the relative valuation of the global equity markets vis-a-vis bonds. So when that falls, when it gets very low, it means the yield on equities is quite low relative to bond yields. It means the equity market is quite expensive. As you can see at the moment, that yield gap, that earnings to bond yield gap, is around about 4%. The long run average since 2003 has been about 4.2%, though that's coloured by the very high levels we got to during the GFC. So at the moment, you'd argue it's close to its longer run average. It has been a bit lower. It has got as low as 2 prior to the GFC. So relative valuation rise, I think the market is pretty reasonable. Though as bond yields rise, you're probably going to see that come in a little bit, and basically see the PE ratio, which is around about 16, maybe come off a little bit as well, but not by a lot. So I think PE ratios for the market around 16 probably won't go up a lot from here, maybe come down a little bit. But bottom line is the earnings growth we're seeing will more than offset what I think will be a bit of a drag on price performance from the PE ratio coming back off a little bit as bond yields rise. But bottom line of all that, even given where relative valuations, the equity market's hard to argue that it's super expensive, despite what you may read in the media. Certainly on a relative to where bond yields are, the market isn't super expensive, and there's scope for that earnings gap to come in a little bit. Looking around the markets, where is relative value most apparent? Just a slide here I nicked from the latest RBA statement. And I guess it shows visually some interesting results. If you look at the PE ratios across Europe, United States, Japan, all markets, in fact, I measured things. If you measure it from 2003, all markets in an outright sense are a little bit above average. Japan is probably the least, has the best value, I guess, across global markets at the moment. So just to give you an example there, so the US market is trading at a PE ratio of about 18. Its longer run average has been about 14.5. Japan is basically trading at a PE ratio of 17.6 versus long run average of 16.6. But Japan usually always trades at a higher ratio. But bottom line of all that is that if you're looking for relative value in the markets, Japan at the moment does seem to be the standout in that it's it still hasn't risen valuation-wise as much as some of the other markets have at the moment. So keep that in mind when we talk about markets a bit later. Now, another thing that's cropped up lately that's causing some angst in markets is a potential risk to equity markets is credit spread. And I've just got a chart there. Again, you may have read in the papers about high-yield bonds weakening of late and credit risks, credit spreads widening. Just sort of put it in perspective there. I've got a shorter run measure. That's the high-yield credit spread. So basically, it's the average interest rate on high-yield US government, high-yield corporate bonds relative to government bonds. So it's a measure of the credit risk. And you can see, yes, it has widened in the past few weeks. In fact, the spread on this measure has gone from about 3.4, quite a low 3.4 in late October to about 3.8 at the moment. But again, it's not. We do get these spikes higher. If you look at a whole rally over the last few years, the sort of spike we've seen at the moment is certainly not untoward compared to what we've seen previously. And if you look at it from a very longer run point of view, it's really just a tiny blip compared to, the big credit sell-offs we get prior to economic downturns. And so far, at least, it's really been company specific, some of that credit widening. You've had a few merger proposals amongst some companies in the United States not go through, and so their bonds, which had been bid in, got bid back out again, so they lost value. And some cable companies and some healthcare, cable TV and healthcare companies have had some poor earnings results. So at the moment, it's been relatively company specific rather than a more generalised sell-off in credit spreads. So just to put that out there, because it has been a talking point of late that, maybe this is foretelling some potential, negative or the, it's the canary in the coal mine, so to speak, to suggest equity markets are going to start turning down. I think it's way premature to suggest that. What about the Australian market? So let's go to that. And I've got a slide there. Basically, we've got a lot of push and pull factors going on in our market. I've tried to put it there in a diagram, maybe not the greatest diagram, but just to show you've got some positives and we've got some negatives. So on the negative side, consumer spending has been quite patchy, underpinned by fairly weak incomes growth despite strong employment, so wages growth being quite soft. Got housing construction, which is at a high level, but again, it's starting to peak, so that is not going to be a contribution to growth next year. And I guess the other feature over the last few months at least has been more signs of the Sydney property market cooling. So house prices, as measured by the CoreLogic Index, have flattened off in the last couple of months, and auction clearance rates, which were running at around about 80% earlier this year, have dropped down to around 65% in the last few weeks, which is consistent with basically prices no longer rising, not consistent with prices falling by a lot, but certainly the steam has come out of the Sydney market, which has been a new piece of information over the last few months. But having said that, there's a number of positives coming through as well. So you've got mining investment, which has been falling for a while, bottoming out. You're also seeing more signs of non-mining investment starting to pick up. So in areas like manufacturing and services and office construction, these sort of areas, you've got resource exports rising. We've got, you know, quite strong conditions in the healthcare sector. Again, the NDIS, which the government has outlined, is really starting to create a mini boom in jobs in the healthcare sector. Education, with foreign tourists flowing back into Australia on the back of the weaker dollar, has also got a boost, along with tourism. So the service sector is really doing quite well. And last but not least is the infrastructure boom. So we've got, again, we've talked about the NDIS. The other thing is the NBN. So love or hate it, but the NBN is being a big contributor to activity of late. And also the road building projects and the rail projects that are going on amongst a number of states. And that is helping to absorb a lot of the construction activity, construction workers that have left the mining sector over the past few years. So a lot, you know, again, it's a push and pull situation, but overall the economy has been chugging along around about a 2.5% pace. The RBA is still talking about it rising to 3% over the next few years. I kind of still think it's going to struggle with that, but I mean, I would say I'm becoming a little bit more optimistic on the economy than I have been for a while, because of these other positive forces coming through. Just to put some numbers, just to give you highlight some of those aspects. The next chart shows you the National Australia Bank Business Survey, and again, so this week we had the Business Conditions Index basically surge up to around about 20. So it's really on a monthly basis, it's the highest level it's ever been. So, you know, businesses at least out there are feeling pretty good about things. And again, it's the infrastructure boom that I've talked about, it's the education boom, it's the healthcare sector, it's the fact that housing construction is still at a high level, albeit peaking out. So, you know, things are humming along pretty well. The next slide just breaks that down into sectors, and you can see most sectors are at reasonably good levels. I guess the sixth sector of the economy remains retailing. And I guess that's something to bear in mind because retailing does get a lot of media attention. So, you know, David Jones and the department stores, we get retail sales numbers on a monthly basis, which have been quite soft. So retailing actually probably gets an undue focus just because of the nature of, you know, everyone sort of understands retailing and sees retailing. But relative to other sectors, it's actually relatively weak. So it's actually giving us a bit of a skewed read in terms of what's happening with the economy overall. Just with the next slide, just to look at retail spending. In fact, if you look at the first slide there, I've got, I think that, so if you look at the values, monthly values, so again, it spurts. You get periods where it's been strong and then it's been weak. So we had a strong spurt of retail spending earlier this year. Last few months, you've had quite a weak patch of spending. But if you look at that purple line there, that's annual growth in retail volumes. It's running around about 2.5%, which is not that bad. So, I mean, we've had a spurt of weakness, but I mean, overall spending is still chugging along at a reasonable pace. And what's been happening is that, if you look at the next slide, households have been running down their savings rate to basically keep consumer spending ticking along, even though that we aren't getting very decent wages growth at the moment. So weak wages growth, weakness in labour incomes, but consumer spending holding up because we've been dipping into our savings rate. But going forward, I mean, if there is a weakness for the economy or a soft underbelly, as I've described it in a recent blog, it is the consumer sector because wages growth is remaining quite soft. Confidence is fragile. Consumer spending is 60% of the economy. So if things do slow down, if it goes from say 2.5% back to say 2%, then, you know, things could be quite a different picture. The next slide, just to give you an update on house prices. Again, a lot of interest in what's happening in house prices. Just give you some slides there that I use in sort of tracking things. Firstly, if you look from an overall national perspective, the affordability measure there, you can see that it's basically it's still close to its long-run average or close to its average since 2004. So from a national perspective, it's hard to say house prices are overvalued, certainly, you know, are unaffordable. And again, the big driver there has been the fact that interest rates are so low But again, if you look at Sydney, it's a different situation. So Sydney is really a standout. So the dashed line there is that affordability measure that I meant. So basically, what is that for those who haven't seen that before? It's basically a measure of the percent of earnings that a household earning average earnings would need to devote to pay off the mortgage for a medium-priced home, given the current level of interest rates. So basically, it allows for the level of household income. It allows for the current level of interest rates relative to house prices. As you can see in Sydney, affordability now is at the peak levels that it's got to in the previous cycles, back in 2003 and just prior to the GFC. So in fact, I did a blog a couple of months ago suggesting the Sydney market is probably going to start peaking out because historically it's got as unaffordable as it's got, and that's what we're seeing. So that sort of affordability constraint is starting to kick in. But again, other markets, Perth, Queensland, Tasmania, Adelaide, are certainly well below their longer run average. So I'd actually see some sort of catch up house price growth in some of those other markets now as the steam comes out of the Sydney market. So, and just to summarise in terms of the Australian market, so we've got bond yields there, the Australian dollar, the ASX and iron ore prices. Interestingly, firstly, if you look at 10-year government bond yields, although US bond yields have picked up over the last couple of months, Australian bond yields have actually come in a bit. So we've had what's called the yield compression vis-a-vis the United States, and really it's the low inflation in Australia, the patchiness of retail spending, and the Reserve Bank signalling that it's in no hurry to raise interest rates have really reduced fears of the RBA, tightening interest rates, certainly in the second half of next year at least, and so that's seeing bond yields come off. It's also helped drag down the Aussie dollar. So the Aussie dollar was threatening to break through 80 cents a couple of months ago, and now it's back more or less back into its range around the mid-high 70 cent range. And I think that's probably heading back toward the low 70 cent range over the next 6 months to a year as the Fed raises rates and we remain on hold. And the other feature there is iron ore has also come off. So iron ore had a bit of a mini rally. And it's softened up again of late. Meanwhile, the other notable feature in our market is that after having traded in a very tight range, the Australian market had a bit of a breakout of late, with the ASX 200 hitting the 6,000 level. So basically, there is some good news. The fears of RBA tightening have eased. The Aussie dollar's come back to a more competitive level. You've got ongoing good growth in global equity markets helping. So our market is basically having a bit of a catch-up vis-a-vis the other markets. Can our market keep going up? Yes, I think it can, given it's going to be dragged up by global markets. But I guess my core view is we're probably not going to rise as strongly as some global markets that I'll mention later. So we're likely to continue to underperform, albeit still participate in what should be an ongoing global equity bull environment. So that's pretty much the summary of the Australian situation at the moment. Again, things are humming along pretty well. The RBA signalling it's in no hurry to raise interest rates, which has been pretty heartening for at least investors in the equity market. Not so heartening, I know, for those of you out there that rely on interest income. I don't have a lot of good news for you in terms of the RBA. But it does mean you need to continue to be a bit more creative in where you look for income in our yield deprived market. So some investment ideas. The final part of the presentation. So firstly, in terms of local ideas, I've just got 3 here. Mid caps, and again, I'll show you an interesting chart in a minute where we have an ETF that tracks not the biggest. Gives you like mid-cap exposure, so excludes the largest 20 companies on the ASX, but it also strips out the smallest 100 to 200 companies that you see on the ASX 300, so it doesn't include all the small caps as well. Also floating rate bonds I'll talk about, and the new one just about to be launched in Australia and is the bank hybrids ETF, which again from a yield perspective will be very interesting. So firstly, talking about the mid-caps, if I just show you the next slide, May surprise some to know that the mid-caps have been really, basically doing very well over the last few years, not just against the bigger caps, so the ASX 20, but also even against the small caps. So if you think about it, generally theory would suggest small caps will outperform larger cap companies over time because they've got greater growth potential, they're more volatile, so the market would reward better share price performance. But the problem with the small cap index in Australia is it includes a lot of dodgy stocks, a lot of like mining exploration stocks, which tend to drag back performance. So the beauty of something like the X20 index, and again, what that is, it's the ASX 200 index, stripping out the top 20 companies by market cap. It's basically, you can think of it in almost like a sweet spot in the market. It's companies that are big enough that they've overcome their growth challenges, so they're not some of the the more challenged small cap stocks, but not that big, as in the big miners and the big banking stocks. So they don't have any growth potential left. So they're a bit of a sweet spot. So put some numbers on that. Over the past year, that the X20 is up 20%. The ASX 200 is up 14%. Again, not bad performance on a one-year basis. And the small cap index, the ASX Small Ordinaries Index, up 15%. On a three-year basis, the X20 is up 14% versus only 3% for the ASX 200. So on a three-year basis, the ASX 200 has really struggled, whereas taking out the top 20 stocks, the performance has been a lot better. And also of interest, the small cap index is only up 10% on an annualized basis over the past 3 years. So that mid-cap one has outperformed. So at the moment, you'll think about our banks and you think about our big miners. I think they all have their own growth challenges going forward. Basically, the housing sector is starting to roll over in terms of housing demand. Consumer leverage boom that we enjoyed for a few decades is over. Like, consumers really can't run up debt relative to income a lot more. So the banks are really constrained in terms of growth opportunities. They'll still give you good income, but in terms of growth opportunities, not quite there. And then with the mining sector, I'm not bullish on iron ore prices. I think they're going to be flat to down from here, so they're going to be challenged as well. So if you want some growth opportunities, X20 I think is an interesting one to think about. In terms of yield, this is one that I've mentioned in the past, but I think it still holds true, is our floating rate bond ETF. So coupon is the code there, QPON. And what that gives you access to is senior bank floating rate bonds. Two advantages. A, is a yield pickup relative to cash. It's yielding something like 2.5% versus the cash rate of 1.5%. Our AAA cash ETF is yielding about 2%, so you get a bit of a pickup on that. And it's relatively capital stable because as interest rates change over time, or certainly as bond yields change over time, because this is a floating rate bond and the interest rate moves in line with the prevailing level of market rates, the capital value of those bonds doesn't vary all that much. So that's one advantage. The other advantage is as bond yields globally rise, they will drag up our bond yields. And so to the extent you have bond exposure in your portfolio, so the typical fixed rate bond exposure, you're going to get poor returns on that because the capital value of those bonds will decline as yields rise. Whereas for coupon, it's pretty much inoculated from that hit to capital values because it's a floating rate rather than a fixed rate bond. So still like coupon, and definitely more information on our website in terms of that. Now, the other one I wanted to focus on is just a very light taste of this index because it's just being launched over the next few days. You'll get access to it. Is bank hybrids. I'm sure everyone is familiar with bank hybrids, and I just want to show you a chart. So basically, we'll be bringing to market a fund that will be a portfolio of hybrids in the market. And again, from a yield perspective, they give you a decent yield. But again, when people talk about hybrids, one issue is the negative case for hybrids is they give you basically, a bond return or a bit better than a bond return, but with equity market risk. So everyone says, they don't really, from a credit risk perspective, if you're holding a bank hybrid and banks become insolvent, for example, you're not going to get any help from holding a hybrid relative to equities. That is true in a sense, right? Because clearly if our banks become insolvent, hybrids will probably get caught up in all of that. But the big thing to think about is the probability of banks becoming insolvent in Australia is minuscule. But the thing is that the share price volatility of banks is still quite high. So even in all the other situations where solvency is not an issue, but you're just getting the waxing and waning of investor sentiment toward bank stocks, you're going to get much less volatility in terms of hybrids. And I just wanted to highlight that with this chart. So the chart there is the share price. This is the drawdown curve. So basically, it's the peak to trough declines in returns on holding bank shares versus holding hybrids and versus holding floating rate bonds. So as we saw during the GFC, when bank shares sold off significantly, hybrids also sold off. Not as much, but nonetheless, it was still a pretty chunky move down. And that was a period where, for a brief moment in time, you know, erroneously, people were fearful of, you know, bank insolvency in Australia during the GFC. But if you look, if you go to the next period of bank sell-off, so early last year, where bank stocks sold off something like 25% peak to trough, there was hardly any movement in the capital value of hybrids because solvency is no longer an issue. So that just shows you the difference between hybrids and bank shares in normal market environments. I mean, it's the relative capital stability of hybrids vis-a-vis bank shares is, I think, the key kind of risk advantage that they offer relative to bank shares. Now, in exchange for that, you do get a yield pickup. So the next slide shows you just an example of the sort of yield one could expect from hybrids vis-a-vis other sort of investments out there in the market. So Australian major bank stocks, so the grossed up dividend yield for bank stocks is around about 8%, so pretty healthy. This overall Australian market, you're getting about 5.7%. For hybrids, and again, the advantage of hybrids is that you do get the franking benefits when you hold those securities. The grossed up yield at the moment is around about 5.3%. So again, it's a doubling relative to what you get on the floating rate bonds that I mentioned earlier. So you do get that nice chunky yield pickup if you hold hybrids. Now, there's a lot more we'll say about hybrids going forward, but I just wanted to give you a taste of that exposure that we will be bringing to market. And just the idea that you get a yield pickup and it gives you not as much as banks, but you know what, because you know with banks you've got to take that capital volatility over time. So you know you're getting compensated for that capital volatility, but you know for relatively low capital volatility you're getting a decent yield. So that's all I want to really say about the Australian market. In terms of the US markets, again, these are regular attendees to my webinars will have seen these before. I still think they're more or less the standout, you know, investments globally at the moment. Firstly, the Nasdaq, then Japan and Europe that I've mentioned, and also global banks. So if I firstly look at the Nasdaq 100 ETF, and again, just to reiterate, the valuations for the Nasdaq are still not high. A lot of the growth we've seen in that market of late has reflected solid underlying earnings growth. And in fact, the latest earnings reporting season in the US, you had, you know, Apple, Facebook, Amazon, Google, all, you know, easily beating analyst expectations. There's a lot of talk about FANG stocks being expensive. Also thought I'd share with you some valuation numbers that, you know, may surprise you. For example, Apple is trading on a price to forward earnings ratio of 14. Microsoft, somewhat higher at 23 times earnings, so good growth potential there. Facebook, trading on a forward PE ratio of 25. Google, 21. So again, they're not low. I mean, it's not 10, 12 times forward earnings, but I mean, it's not 60. It's certainly not the levels that we saw, you know, for some companies during the dot-com bubble. So, you know, 25, 20, given the growth outlook for those companies, I still think is fairly reasonable. Of course, Amazon is trading on by my estimates, a PE ratio of 70. But again, Amazon is one of those companies that's given up profitability in the short run for market share. So it's really been going for market share. and the markets are still basically giving Amazon the benefit of the doubt, thinking that it's going to capture a lot of market share and a lot of growth potential going forward. So, earnings reporting season just passed in the US, really just affirmed the ongoing strength of the tech stocks that are really dominating the NASDAQ index. The other note on the NASDAQ is the tax package that is still winding its way through Congress in the United States. You're seeing some more details of that, and they're talking about giving companies that with a lot of offshore earnings squirreled away a tax break, basically only charging them 10% versus 35% whether they bring that money back home. So if that tax package gets up, it's looking more and more likely it will, that could be a big boon to earnings per share growth amongst those companies with a lot of money offshore, because they'll bring that money back onshore and it'll probably help fund share buybacks and increases in dividends. Japan and Europe, and again, if you recall these slides I showed earlier about the good upturn in the global economy, and particularly of late in Europe and Japan, that's just showing you the relative performance of Europe and Japan vis-a-vis global markets. And funnily enough, this year so far, they've actually underperformed somewhat, and it's because the US dollar has weakened and the currencies of those markets have strengthened. But again, I think the US dollar will strengthen and those markets will, and those currencies will weaken. They will again start to outperform. You're already seeing some signs of outperformance starting to come through in the most recent few months. So I still like those as exposures as well globally. Last but not least is global banks. And again, with bond yields in the US starting to turn up of late, this is going to be another feature. You don't see it quite as clearly on this chart because it's a monthly chart. It's going back over time. But basically, the negative correlation, basically when bond yields globally are rising, global banks tend to do quite well. And in fact, over the past 3 months, global banks are up, 5.5%, and over the year, up something like 30%. So again, it's doing quite well. And the other feature, again, as part of the love or hate Donald Trump, he is still talking about financial deregulation in the United States. And in fact, the latest, the new person to take over the Federal Reserve next year, Jerome Powell, will take over from Janet Yellen. One of the reasons that he was, the talk is one of the reasons he was chosen is that he is more favourable toward further financial deregulation in the US, which is what Donald Trump wants to pursue, which will be favourable for US banks, and again, which form a big chunk of that index. So global banks, again, bond yields rising, global banks are one of those few sectors globally which will benefit in a rising bond yield environment because their net interest margins widen out. They basically earn money as bond yields rise. So I still like that exposure as well. So that's pretty much it for another quarter. I hope you got something out of that. Again, bottom line, things are going along pretty well. Just keep watching the inflation numbers, keep watching the US wage numbers, but provided inflation stays low, the markets, I think, are still well positioned for reasonably good gains over the coming year. Our markets should do well in that environment, but probably not as well as some markets overseas. And again, the other new piece of information, that bank hybrids, if you are looking for yield in the local market, it presents another interesting exposure to consider. And some risks, obviously, as we said earlier, seek some professional advice before investing. Past performance, not an indicator of future performance. Obviously lots of different things can happen. All of our funds have product disclosure statements associated with them. If you'd like to read them, they're definitely available on our website. And thanks very much for your time. Happy to take questions.
Thank you, David. Great to hear you sounding so positive on everything. And highlighting Japan for those who weren't aware, and then just putting some context around those credits, those widening credit spreads. We do have some time for some questions, so if you'd like to send those through. We had a particular thing you mentioned, a soft spot in the consumer area, and one of the questions was, has this been impacted by Amazon? So the Amazon effect, people holding off from spending on that?
That's a good question. I hadn't thought about that, but I mean, possibly people holding off. I don't think so. I don't think it's a big driver at the moment, but you know, a couple of things have happened over the last few months. Electricity prices, we had a big hit in terms of electricity prices, which squeezed household incomes, and so that's been seen as one of the reasons why retail spending of late has been weak. You've also had petrol prices go up on the back of rising oil prices so far this year. So a bit of a squeeze on incomes and, you know, ongoing weakness of wages growth. And I guess the other point is, you know, retail spending on a monthly basis can be volatile. It tends to wax and wane. So we had a few good months earlier this year, and then things slowed up again. But yeah, I mean, overall retail spending it's chugging along at a reasonable pace, not a super strong pace.
Okay, there was a question earlier on about bond yields and what people should pay attention on bond yields, and that the inverted yield curve in the US, could it be a precursor to, you know, an upcoming recession?
Yeah, look, another good question. The yield curve, you know, is quite flat in the US and historically has tended to be associated with a downturn. I guess I'd just say, like, at the moment, like the longer end of the yield curve is being distorted by central bank purchases. So it is an unusual situation because, you know, you've got central banks around the world buying up bonds and artificially holding down the yield on longer term bonds. So I think the yield curve is not giving the read that it's not giving a true read of the situation at the moment.
And then just touching on rate rises from central banks, is it likely that the politicians will sort of influence and resist those rate rises from the central banks due to the cost of servicing the rising levels of government debt?
Well, thankfully, most central banks around the world are pretty independent, so I don't think that will be a feature. I mean, at the end of the day, what's causing central banks to be slow in tightening is just inflation. It remains so low, and you know that's going to be the guide in terms of what central banks do. Not necessarily any worry with deficits. The one area where that is you know, I guess it's not government so much doing it, but if you look at Europe, for example, when you do get blowouts in, say, Italian and Greek debt and Spanish debt, you've had the central bank come in and buy that up. So that is a bit of a political issue because they want to hold the Eurozone together. So only in that sense would you say that, you know, politics is sort of having an influence on central banks, but otherwise it's really just will depend on what happens with inflation.
Mm-hmm. And the risk to the economy of the household debt levels in Australia and elsewhere, so the rising household debt levels.
Yeah, like household debt levels in Australia, yeah, look, they are constraining retail spending. We're seeing that. You know, the real growth in spending is around about 2.5%. Once upon a time, it used to grow at 3.5%, 4%. It's a two-edged sword though, because the Reserve Bank in Australia is very much aware that, you know, high household debt is constraining consumer sentiment and constraining spending. So it's basically a constraint in turn on what the RBA would do with interest rates. And that's why I go back to inflation. The worst case scenario for us and for global markets is a strong uptick in inflation, because if inflation does pick up, central banks will basically have to say, well, irrespective of debt, irrespective of everything, we've got to slow things down and we've got to jack up rates. And that's when things will get really nasty. But provided that doesn't happen, they'll basically take the fact that debt is in hand, is high, and be very cautious in how quickly they raise interest rates.
Thank you, David. So we've had a few questions on our hybrid fund that David did mention at the end of the presentation there. So if you aren't already, please do sign up for our newsletter, because we do obviously communicate our fund launches, but it will be coming this week, so please stay tuned, and we will send something out very shortly this week about the launch on that and some further information. And as always with all our funds, we do have you know, information around it and all the fund information on our website. We've probably got time for just one more question, Dave, and it's something we get asked all the time. And as you've mentioned, a number of our ETFs about the liquidity of ETFs. So, and just how liquid are ETFs?
How liquid ETFs are as liquid as the underlying securities that they hold is our answer to that. So basically, when you go to if you go to your share trading website and you look at sort of the bid offer volumes, or you look at the level of trading in a certain ETF, it may suggest that, you know, it's not very liquid, it's not well traded. That really, in the case of ETFs, is a completely erroneous or misleading guide to the underlying liquidity. So basically, you know, if there's like $1 million bid offer either side for an ETF, and you want to buy less than $1 million worth of an ETF, you can easily, you know, buy it. And if you take some of those units, the market makers behind the ETF will basically be able to easily replenish the stocks available, provided the net asset value of the ETF hasn't changed, or the market value of the underlying security. So don't be misled by in the level of trading activity and the level of, you know, the market depth, I guess, of some ETFs. Because at the end of the day, you've got a market maker behind them who is prepared to provide reasonable quantities on either side of the market at prices very close to net asset value.
Great, excellent. And you did a recent blog on this, and you alluded to throughout the presentation that some of these things you've been talking about for a little while, and are all available via our weekly newsletter to get the very latest from David Bassanese, and then also thoughts around from the rest of the team too.
Just on that, yeah, so if you do have ongoing questions about ETF liquidity, go to our website and look under the insights. There's a thing called ETFs Fact versus Fiction, and I've got a 2-part blog going through some of those issues there, and that will help shed light on many of those questions. Great.
Thank you very much for joining us today. As I said at the beginning of the session, we will be sending around a recording of the session today, and we thank you very much for joining us for our latest quarterly market economic update. Thank you.